All right. Hey, good morning, everyone, and welcome. Thanks for joining live. I'm going to just jump right in here. I know it's not quite 7:30, but that's okay. We got a lot of stuff to cover. So first of all, as we get going and start talking about this stuff, we're dealing with things that are outside the norm of grain trade, right? We're not talking about weather. We're not talking about supply. We're not talking about just the good old fashioned stuff that we like to talk about. Will it be hot and dry in Iowa and wet here? That's the fun stuff. We're dealing with stuff that's unprecedented and completely unpredictable. So I can't give you any insight as to what's going to happen, but I can help frame the issues up for why we're doing what we're doing. But before I do that, while the market's trading here, I want to show you what's happening in the options markets because I think it's really telling what's going on. So I've got in front of you a corn May option chain. And so for those of you that aren't familiar with these are different strike prices for options, okay? On the left, you have calls, and on the right, you have puts. So the price of a 7:30 May call is 46 bid, 48 ask. A May put is 46 and 47. And these are going to disappear here pretty soon when the market closes, so I got to talk fast and work through it. Options are priced based on models, right? And one of the functions that goes into that pricing model is implied volatility. Typically in the corn market, you're going to see implied volatility somewhere between 15 and 25%. Anything over 30 is typically pretty high. And you can see here, we're trading at about 43% implied volatility on the nearby options, which causes them to be more expensive. So a nearby straddle, which is buying an at-the-money call and an at-the-money put or selling them, is trading for 92 cents. That's telling you that at the current minute, the options makers, the people that are writing these, selling these options to you, back in a few years ago, it would have been in the pit. They're telling you that these options or the price of corn should be within about $1 range over the next 51 days. $1 higher, $1 lower. It's extremely high, and it makes it extremely difficult in order for you to make money when you're buying a put or buying a call. That's my point, is that it's extremely high. It doesn't mean that we're topping. What it means
I'm muted.
is we think that we're going to have extreme volatility coming on for a while and for an ongoing basis. In May wheat, it's even more extreme. So typically a at the money wheat option, and you can see here I don't even have a best bid and ask on the May options, but typically an option in wheat with 50 days left is going to be trading for 25 to 35 cents with an implied volatility of somewhere down in the 20 to 35. We're trading almost 70% implied volatility with an at-the-money option trading for $1. That is a truly insane number of things to deal with. So a guy could go out to 12.50 and sell a 12.50 call for 52 cents a bushel this morning if you could get it cleared. That's something not far out of the money. Should be trading closer to 3 cents. So the fear in this market is really palpable, and the expected move in range is increasing, not decreasing, into the events that we see unfolding. So the point of all of that is to say, the pros, the guys that make money by selling options and are trying to capture all that theta and make a market for you, are saying this is really risky for them and they don't know what they want to do with it. So I think we got a lot more volatility coming. Okay, so now let's go to the charts and let's kind of frame up some of the issue here, okay? So we don't know what's going to happen with Ukraine. We don't know what's going to happen with Taiwan and China, and we've got all this global posturing. So, but what we do know is that at the moment, exports are non-existent out of the Ukraine, and it looks like exports are going to become tougher out of China. So for wheat, what that means is that over 40% of the world's export market is now offline. So the market's job in this event is to redirect the bushels. It's got to first address supply and demand to make sure we have adequate supply. And its only mechanism to do that is through price. So if you pull 40% of global exports out of the market, you have to take price to a level that either A, increases supply, or B, decreases demand, or in other words, rationing. So that's why you're seeing wheat go limit every day as it moves up. And I guess I should put the wheat chart up here for you instead of corn. So here's wheat. We're locked limit on expanded limits, trading 1078 a bushel here this morning, up 75. You've got 40% of global exports off the market, which means they have to come here because we're the world's residual supply. So the market has to ration demand or increase supply through flat price. It has to readjust basis and freight levels in order to pull and incentivize buyers to come here in order to pull it back, which is bullish, in order to pull it into market, which is bullish basis. And honestly, it's also bullish freight. So I don't know where this market could top out. I have no way of predicting that. What we do know is that if you look at the monthly chart, is that we just broke a pretty significant set of levels. So we just broke this 990 level, which was the high dating back to February of 2011. And we talked about this last week. The last time the Ukraine got hot and dry and the Black Sea region really got taken out of was back here in 08, when we hit the all-time high at near $14 a bushel. Back then, we were talking about maybe losing 15 to 20% of global export demand, not 40. So the implied move that could happen here in wheat, if this conflict were to persist, is exponential, and you can't predict the target to it because you just don't know where it would go. So that's why the options markets are trading with so much premium built into them, because the makers know that that's happening, and so they're unwilling or hesitant to take any short risk. And so I would say don't be tempted to go out and sell nearby call premium, because at least until we get some indication that things are going to break, because you could see it just explode right up to these all-time highs. And you got to think, why wouldn't it? Unless we get peace really rapidly, and this conflict opens back up that export supply, why wouldn't we trade up to that level? I think that's the question that I want to leave you with wheat, is why would you step in front of it and sell it until you have some sort of a resolution? Because we just simply don't have the bushels. And if you assume that that's the case, then you have to put a lot of premium in here, because you got to realize that we're in a drought, and last year's wheat crop wasn't that stellar, and we just don't have the acreage to make up the room for what they're leaving on the table. So I think there's a lot more to go. I don't know when it'll top. It will for sure eventually, but I don't think it's going to be today. If it does, we'll deal with it when that happens. All right, so let's talk about corn for a second. What's going on with corn? It's a little bit different fundamental situation than wheat, but not completely. So we've been dealing with a crop loss in the first planted corn crop in South America, right? Let's start there. That crop accounts for about 35% of the South American production, and we think that it was about 1 billion bushels short. USDA hasn't confirmed that, but that's the best number that we can come up with. They lost somewhere between 750 and 1 billion bushels off of that crop. So the market in January and February kind of bounced around this idea, saying, well, they're going to plant their bigger crop, their safrina crop right now, and they're going to plant that crop on extra acres in order to, because of the high prices, and in order to make up for the losses in soybeans and corn. Well, I hope that they do, and I hope that the weather stays good there, because in the Ukraine, there's a 500 million bushels that are currently in storage that are trying to make their way into the export market, but are shut down due to damage and just the conflict and the instability in the region. And then beyond that, there is the potential that and some doubt as to how much of next year's crop the Ukraine will be able to plant. And if they don't get that planted, then that could be somewhere between 20 and 40 million metric tons, or 750 and 1.5 billion bushels that never get produced to come to market. So you're talking about 500 million bushels in the nearby, 750 to 1.5 billion in the deferred months. So you're looking at a possible total contraction of 2 billion bushels on top of the billion that South America already lost. So that puts incredible pressure on us to grow a huge crop. So the corn market also has to, and this is what I think it's debating right now, it has to decide whether it's got a ration or whether it just needs to encourage supply, right? Remember all the other underlying factors we've been talking about. You've got drought issues, you've got fertilizer issues, you've got input costs. I mean, you've just got all these issues underlying the corn market anyway, and now you've got to decide whether you've got to replace 2 billion bushels or not. And so I think you got to assume that the corn market is going to go ahead and continue on this march higher, because it can't discount itself to everything else. There's just not enough supply until more is known about that supply equation. So I think you got to stay long corn. And if you look at the weekly chart, man, it looks really, really good. I know this is kind of messy here, so let me walk you through it, okay? So what are we looking for in technical analysis? Well, we're looking for signals that reinforce each other or conflict. So let's look what this one is. We know we just broke out of this cloud. We've been talking about it for weeks. A breakout of this cloud typically means about a $2 move. A wave 2 or a 2 down in here typically means a large move, and you can predict with Fibonacci extension tools where that might go based off of the decay from peak to trough. And first target is 886. Second target is 955. I'm not going to go to targets above that because I don't want to scare people. But I think you've got to assume that given this setup, momentum is super strong. We're ticking straight up on every indicator here. We're not overbought. We're not diverging. If anything, corn is just beginning its move higher because it's got to start digesting all these things we just talked about. So even though the corn markets, you could sell a $8 call for 30 cents this morning in July. That's unheard of. That sounds like a really great deal on its face, but not if corn goes to 9 or 950. And why would it do that? Well, because if this conflict persists, it's going to do that. If we get hot and dry, it's going to do that. If South America stays hot and dry, it's going to go higher because we do not have the ability to create enough bushels. We have to stop demand in order to ensure that we don't run out of corn. So pretty dire stuff there. We've been talking about this for a while. We didn't know what the fundamentals would be that would propel it this high, but here they are. They're starting to manifest themselves. And I don't see what would break it, short of Putin just saying, "Oh yeah, you're right, my bad. I'll back out, and you guys are right. We'll just take a back seat to Russia, and we'll be the world's laughing stock." I think that's just extremely unlikely. So now that brings us to soybeans. Soybeans aren't really grown in the Ukraine, right? So they're not they're not uh, subject to the same demand pressure that that corn and wheat are, and they're trading like it. Last week we had this giant move from 1759 all the way down to 1570. So you got a $2 swing in less than 24 hours, and then you have now you've put some pressure right on back up here. And technically, soybeans actually look pretty weak, right? You've got these divergences that are forming on the RSI. You've got divergences on the force index, and you've got divergences on the MACD. So we've sold beans a little bit heavier than everything else, and I'm glad that we have. But I'm definitely not willing to just go outright short soybeans with the explosiveness of what could happen in corn, because soybeans can't give up acreage either. So you can't just rally corn and push 5 million acres to beans, or pull 5 million acres away from beans and push them to corn, because they have their own story. Because remember, we just lost 1.5 billion bushels of soybeans as well in South America. So yes, that's what got us up to here. And yes, if corn wasn't going to rally on up, we're probably okay with beans. But if corn keeps working higher, beans have to too, because they just can't afford not to. So I would not be a seller of anything at the moment. I would just pay attention to it day after day. We'll be watching it, and when we start to see something really shift, and I'm going to watch the option market volatility, because I think it will break first before price. When we start to see that volatility come out, that's going to tell us that the large market makers are perceiving less risk. And I think that's when we want to start being much more active. Otherwise, I think we need to just sit back and let things play out and manifest themselves. So I'm going to end this with the supply talk, right? When is new supply going to be available to the market? South America is going to harvest their corn crop in June. Their safrinha crop, their big crop. So between now and then, we should have some weather issues develop. And if they get hot and dry, that could be very explosive. If they plant a ton of acreage and the weather turns perfect, that could pressure corn, but not today. Of course, we're getting ready to plant, right? So same thing happens here. Our weather market typically happens in June and July. August for soybeans. So we've got a lot of time left before new supply is available to the marketplace in order to kind of readjust things globally. So I don't think we want to be super itchy to be selling, and I know the prices are good, and we don't want them to get away either. But our job here is not to call a top, because in order to call a top or to sell a top, you have to stand in front of a freight train. And I'm really not willing to do that. I think we got to just let it go and let it take us where it wants to go, and then we'll start making decisions when we see reasons to do so. And we'll keep you posted every day and every step along the way as that happens. So with that, I think we're good for today. I think that we're good until next week. I don't see anything that's going to stop it. I don't think we're going to go limit up every day, and I expect it to be wild and highly volatile. Wheat at 4 a.m. wheat was locked limit. By 5:15, wheat was unchanged. Wheat had a 75-cent sell-off, and now it's back. And literally 30 minutes later, it was back up 60. So in less than 45 minutes, wheat moved $1.50 in price. That stuff's going to happen, and we expect that to happen, and that's why we don't want to step in front of it and try to trade it, because it's just too risky. So what we want to do is be ready mentally to sell it when it tells us to, and otherwise we want to stay away from it and just let it do its thing. I hope that's helpful. Obviously, there's tremendous risk in trading these markets, and you've got to be open and available to what they're telling you. We're happy to help anybody analyze anything that they need. Otherwise, I hope you guys have a great week, and try not to stay married to your screens, and try not to live and die by every quote. We'll keep you posted as things happen, and if we need to take action, we'll be quick to say so. I hope you guys have a great week. I will talk to you next Wednesday.